Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community.
I'm Nathan Stovall, and on this episode, we're talking about the outlook for bank M&A activity as 2022 comes to a close. 2022 has been a tumultuous year for bank deals. Elevated inflation and the Fed's efforts to tame it through swift tightening sparked recessionary fears and led to pressure on bank stocks as investors began to worry about institutions' credit quality and liquidity. Lower valuations reduced how much buyers can pay for targets, but really the spike in rates and the required rate marks that buyers have to take when completing a deal have been perhaps an even greater hurdle to getting deals done. And as we're coming to a close to the year with a little over a week left, the number of deals have fallen 20% year over year and deal values fallen even more, 70% year over year to just $22 billion. While that all sounds kind of negative in terms of the deal space, deals are still getting done. And our guest on the show co-heads the Financial Services Investment Banking Group at a firm that's worked on 6 transactions totaling almost $1.5 billion in just the last month. Coming on the show is Bill Burgess, co-head of Financial Services Investment Banking at Piper Sandler. Bill, thanks for joining us.
A pleasure to join you, Nathan. Thank you.
So, Bill, as I mentioned in the opening, the pace of deals is slower, and we've heard lots of talk about the rate marks and concerns over a potential slowdown sort of getting in the way of transactions. And so much that we had even heard some folks in the advisory community say that some deals weren't even really doable. But as I noted, the firm's worked on more than a handful of transactions of late. What in your mind is driven recent activity, and how are buyers getting comfort over taking the plunge at this point in the cycle?
Well, I think that I may have a contrary view with respect to the impact of interest rates as a real negative for bank M&A. That we can talk more about that in a moment. I think that the most recent activity is kind of normal course bank M&A with targets that are looking for liquidity. And what we're seeing more and more is buyers who are trying to find liquidity as well. Seller liquidity is more, I want to get out of my stock and pass along the dollars to the next generation. The buyer liquidity is becoming much more of a focus as loan-to-deposit ratios have risen. Liquidity in terms of more core deposits to offset what remains strong loan growth in the industry. And we saw that in a transaction in the Midwest. We're seeing that across the board with loan-deposit ratios now in the mid-90s. Core deposits are starting to matter. And frankly, they should be more expensive than they are, but given where bank valuations today stand, they're cheap relative to the other liquidity alternatives for the buyer universe.
And just unpacking that's interesting. I had pushed on that several months ago with folks in the advisory community that why aren't we seeing funding playing a bigger role? I'm not surprised to hear you say that. When you say that they should cost a little more, are you just talking about core deposit premiums on transactions?
That's correct. The pricing nowadays for bank deals is getting closer and closer to tangible book value, which means inherently the core deposit premium, which is just that premium over book value divided by the core deposits, is going to fall. We're seeing core deposit premiums now that are kind of near decade lows at a time, interestingly, when core deposits should be all the more valuable because a 0% core deposit versus where you have to go to the CD market today is a noticeable impact on net interest margin. But the real driver, I think, is that if you look at the Fed data, you're looking at 10+% loan growth for banks, and that upward sloping line continues to show resilience. At the same time, the deposit outflows began last quarter. It was lower growth, but now it's actually negative growth. And so, not a math guy, but if you've got deposit outflows and a lot of loans coming on the balance sheet, that's why you start to see banks in Chicago showing 95% loan to deposit ratios. And that's just not sustainable. So you see more and more buyers trying to find ways to bolster their core deposit base through M&A. And we're doing more screens for banks of banks that have targets that have some size, some scale in market, but more importantly, either have liquid assets, mortgages that can be divested to capture the funding piece of it, or just low loan to deposit ratios overall. A $1 billion bank with a 50% loan deposit ratio is an invaluable battery today to plug into institutions that really do not want to throttle back commercial loan growth at a time when they're seeing fantastic loan yields.
Mm-hmm. And as you talked about too, not only just on the loan to deposit piece, but something we're even hearing from the regulatory community, who's normally pretty quiet and not necessarily quick to raise alarms, talking about the liquidity piece pretty extensively, and specifically as it relates to the securities portfolio and bonds being underwater, and just sort of looking at that picture and kind of saying, okay, maybe that's not one lever that might be available today as it would have been in past cycles. So, I mean, does that just go further into the thinking of I want deposits more now than I have in a long, long time? And certainly from 6 months ago, gosh, I mean, even 6 to 12 months ago when we were also liquidity rich. Is that going into the calculation for some of the guys you're working with?
Well, not surprisingly, it's not a headline for the investor relations decks or the conference calls that follow deposit-driven M&A, but it is a part of it in the background.
Mm-hmm.
If you've got $1 billion of AOCI losses, unrealized losses within your bond portfolio, you'll recover all of those losses when the bonds pay off at par in the next 1, 2, 3, 4 years. Pretty sure that if you sell those bonds in order to fund new loan growth, you're going to capture those losses immediately. So I think that banks are reticent to sell bonds today and effectively capture those losses. They much prefer to see them creep back into earnings over the course of the next 2 to 3 years. But I think that it is a driver for them to look at outside sources like M&A to avoid having to capture the losses, yes. But that people will talk about that behind closed doors, but it's not going to be front and center in the press release, certainly.
Sure. One of the pieces you mentioned too, sort of the 50 loan to deposit ratio target, is just an example. I remember in the last rate cycle, some buyers talking about looking at targets in more rural markets because they might not be as loaned up. I haven't heard that talk as much yet. Are you seeing that crop up now with buyers who maybe are in metro markets looking at slower growth markets is a funding play?
I think we're looking at whatever is available, let's be candid. The rural markets certainly have shown to have lower betas for the depositors, and the attractiveness of those franchises has increased. The issue, of course, is that the number one market share in western Nebraska isn't going to have $1 billion of deposits to put to work. So size and scale matters also. So we're now including adjacent markets in addition to in markets for banks and large MSAs as they try to sort through how they could either take advantage of the dearth of buyers at the same time bolster the right-hand side of their balance sheet.
On the sell side, I kind of wondered, could this promote or encourage, maybe a better word, more people to consider partnering, the idea that their liquidity is getting a little stretched. But I'll even offer a counter to myself on that question. If buyers are looking for liquidity, does that, if you are a seller saying, okay, we've kind of gotten stretched and now we're going to look to partner, does that make you a harder pitch, so to speak, to a buyer if you are a seller in that situation? And are you seeing that kind of changing the thinking for some would-be sellers?
Well, in a market where their buyers are trying to find additional sources of core deposits, a seller lacking that liquidity is going to make itself less attractive, certainly. Look, I'm still bullish about 2023 in terms of there being 3 to 4% of the banks transacting like we've seen in prior years, barring an overt recession, and I'll come back to that. And I think that there are ample opportunities for 200, 150 to 200 transactions again next year. I think that you'll see institutions that have great core deposit franchises more sought after than 3 years ago. No one cared about deposits 3 years ago. People were talking about charging people for dropping more than a certain amount of deposits in some of the larger institutions. Liquidity was everywhere. Now it's actually sought after. So when we talk to institutions that are considering a sale, and maybe considering a sale because the patriarch passed away or it's just the right time, or they're seeking a safe haven with a larger bank balance sheet, larger geography, more diversification, than just want to swap their stock into a larger institution. Be that as it may, if you have a seller, you have to kind of sort through the buyer universe, and each attribute for the seller is going to be different for the buyers that you contact. We have one example that we have a liquidity issue for a seller, but in a very unique way, when they have an earning asset generator that is just able to create so many earning assets that the bank itself just can't fund it, and they can't find buyers for the loans fast enough. So there's always an impetus for sale that will kind of spur interest from different parts of the buyer universe. But at the highest level, we're going to see more deposit-driven transactions in 2023, particularly if you continue to see strong loan growth and you don't see any overt change in the macroeconomic environment.
Mm-hmm, mm-hmm. One of the pieces that maybe gets too much attention from guys like us is sort of the headline reaction to transactions, and it feels like the street's been a little bit negative on bigger deals this past year. When you look at the data on the one-day stock reaction, all transactions is pretty similar, but it to past years is pretty similar in terms of investor reaction. The bigger transactions seem like they've been a little bit more heavily punished. Do you think that's played a role in any acquirer's sort of calculus and approach in a deal? And maybe the second part I would ask that to you is, like, do you think that's been fair in cases? Or maybe the investors have kind of missed it, that they've just been sort of selling the news saying I'm uncertain about the future, that they're missing kind of the value of those deals?
Well, I think that it absolutely plays a role in buyers' willingness to consider M&A. It shouldn't. I think we should focus on where the stock is at the closing of a deal, and maybe a year after the closing of a deal, than the immediate reaction on a one-day basis. I will also say that if you have a transaction where the stock price goes up, investment bankers are permitted, per our charter, to point to that as a trend. If it goes down, however, we will obviously say that that's something that you need to focus on for the longer term. I've had CEOs explain to me that they don't need my help having their stock price go down 5 to 10% in a day, which is accurate. But in all candor, you need to think about the deal a year later, 2 years later, when you're contemplating M&A of consequence. If you're buying a branch, it doesn't really matter, nor should your stock price move. But there was a transaction we worked on recently where the stock, very similar sized deals. One had the buyer stock go up 0.5%, which is great. And then a few weeks later, we had one where the stock price for the target, similar size, the buyer stock went down 10%. And very similar deals, very similar metrics. Very hard to understand why one was up, one was down. And the expectation, I think, is that come the closing of the deal, come a year or two post-integration, each CEO will look back and say they were thankful that they pursued it. You really can't be driven by the short-term nature of some of the investors that are in your stock on a daily, weekly basis. You got to think about the long term. And that's a good piece of advice for any institution, but it's hard to get your arms around that when you see some things that negatively impact stocks, and you want to avoid that at all costs if you can do so yourself.
Mm-hmm. And something just on that topic that I know you've told my colleagues previously, and I've heard others say that I think makes a lot of sense, is the importance of communication, really spelling out that transaction over the longer term, but probably even preparing your investors for the idea that you could announce a deal like that. I'm not saying that was absent in the transaction you mentioned, but investors don't like surprises, in my experience, and helping them understand what you're trying to do and why you're trying to do it, and preparing them ahead of time seems like it's only going to be better suited for them to receive it well.
That's absolutely right. And sometimes your M&A strategy begins with just soft sounding the notion with investors a quarter or two or three prior to even embarking upon an outreach and trying to get a sense for who the target universe might be. And, giving them the confidence that you can execute transactions is going to require explaining that strategy, oftentimes over the period of a year pre-announcement. And I think that is not just your willingness to pursue M&A as a supplement to your organic growth strategy, but also identifying what geographies are inbounds and which are out of bounds. Would you look at nationwide earning asset platforms to bolster your loan growth, or is that something that you would not consider? Are there geographies that investors can know that you're not going to enter into? Are there industries? Are there business segments that you're going to rule out? Because I think some folks get a little bit concerned that ambitious management teams might go into areas that are going to have more risk, and investors want to make sure that they don't have that surprise that you referenced.
Highlighting what you don't like as much as what you do sounds like that's just as important. That's really interesting. I mean, that just gets them on the same page with you to avoid those surprises.
I agree.
So you mentioned that you're pretty confident for 23. What does the pipeline look like right now in terms of clients that you're speaking with, and does it look healthy, or more that you have more confidence that as we kind of get into 23 and we get our arms around what the operating environment looks like, that you could see a pickup there?
Well, I think that the two things that are restricting M&A today are, number one, the regulatory outlook, which really pivoted in July of 2021, and the prospects for a recession. So I'll hit the negatives first, and then we could talk about the positives. The regulatory world has changed for particularly larger institutions, and we're seeing that in terms of the delay it takes to get larger transactions closed. Now, for a $500 million transaction or larger, there's 3 of those in 2022. When you look at the closing dates for those, it's oftentimes 290 or even more than a year after the announcement, and that's rough, and that's new, and that's not a help for management teams contemplating M&A today. The target is less valuable every single day, and if you can close it in 90 days, that's great. You can close it in 400 days, that's not as attractive. And it also adds an element that it's a phrase I've been using a lot, is opportunity cost. If you have a transaction you want to pursue, if you're U.S. Bank and you pursue Union Bank, if you're BMO and you pursue Bank of the West, if it takes over a year to get that deal closed and it takes a year to integrate it, you're not really back in the M&A world for 3 years post-decision to pursue that target. You damn well better make sure that that's in the top 2 or 3 on your list, lest the number 1 guy on your list calls you, 3 months after you announce, and you really can't act on it for years. So opportunity cost was obvious for the larger transactions, and it's becoming more important even for the smaller transactions, where having more than 2 regulatory applications with the Fed probably is going to be challenging unless you are a well-experienced acquirer with uniquely superb regulatory relations. So opportunity cost, regulatory environment, it's been a headwind, and it really has, in some ways, stopped the larger transactions. I mean, keep in mind, there's, again, 3 different transactions this year, over $500 million in size. That same number last year was 23. So, if your bet as an investment bank is on the larger transactions, 2022 was a year to forget, and I think 2023 will be a year to forget. So regulatory environment matters. That's not going to get a whole lot better. So I think the large cap M&A world, top 25 banks are handcuffed. The interest rate piece, again, not as worried about that as even about the economic backdrop. Now, that figure I gave to you in terms of the number of transactions over $500 million in size, for 2009, I know that number off the top of my head, it was 0. So nothing's going to happen if we get to a place where we're concerned about credit losses. We have institutions across the board, from Wells Fargo down to the bank in Topeka, trying to find ways to offset credit losses with equity raises. So if that happens, the brakes are fully set. But if we continue to kind of move sideways like we are now and have been for 6 months, with loan growth, deposit outflows, rates all over the place, but credit steady, I think you're going to continue to see, the 150 to 200 transactions per year, that 3.5%, 4.5% of banks outstanding transacting, and it'll be, more small deals and large deals until you see a change in the regulatory world.
And on the regulatory piece, in terms of delays, not to pile on the negative, but I mean, one other thing about not only are you limited to how many you can do at a time, and you might miss the one you want, there's risk just in the time that it takes to close, where you've got internal risk of employee fallout and customer fallout. Everybody gets sort of spooked. The faster you can get that team together, the better off you are. So, I mean, there's definitely risk there. On that last piece, though, what's kind of interesting to me, and you didn't quite go there, but I almost feel like it's as long as we get some clarity on where credit is going, certainly if it's this benign area, but it's not a sky is falling scenario, that as long as we get some handle around what it is, there's a price for that. And you'll continue to see transactions come off at kind of a healthy pace. It feels like we're kind of in that wait and see now. Okay, what's the impact of higher rates? But we're getting closer to that terminal rate, it feels like. And to me, it feels like it's possible that as soon as we get closer to, okay, what does the world look like under that environment, you might see more confidence for people to move forward with a transaction. But I don't know. Do you agree with that?
I think that's right. Again, I don't want to downplay the importance of AOCI or just the massive amount of unrealized losses embedded within bank balance sheets today, not just in the securities portfolio, but also within the HTM portfolios, in the loan portfolios. And again, M&A means you got to mark to market everything. So if you think you're smart because you've got all your securities in HTM, you still have those same losses. And purchase accounting means you got to mark those too. So I don't underestimate the size of that issue, but it's just math. And if there's one thing that banks are adept at, it's understanding the impact of changes in interest rates to their businesses. They do it every single day, and we can quantify with precision how fast you're going to recover an unrealized loss on a $100 million bond portfolio. So, I mean, I know it's not necessarily something that people are excited about. I mean, it's awful, but we can quantify and get by that. It's the point you made with respect to credit portfolios. No one wants to catch a falling knife, and thus far, we're seeing no real cracks in credit. So people are looking at the subprime, people are looking at commercial real estate, people are looking at the first indicators of a downturn in credit. Everyone's there's a new canary in the coal mine every week, it feels like, but for the most part, everything's held up okay. So if that starts to change, I think people will hit the brakes because no one wants to be the last buyer of a $10 billion asset bank the day before the crisis in credit began. But on the interest rate side, I mean, it's harder, it takes more time, there's some more risk involved. But for the most part, I think we can quantify the impact, and we try to show investors the impact with and without those marks. And I think it has assuaged a lot of the concerns that investors initially had about the impact of rate movements on M&A.
Mm-hmm. Mm-hmm. Certainly. And we've seen much more in the way of disclosure on those transactions and just building it out in terms of with and without the impact from marks and things like that. Well, here's the hoping as we close the year that we get more stability, we get more clarity, which would be good for everybody, but certainly the deal making environment as well. Bill, thanks so much for taking the time to chat with us about it. We definitely appreciate it.
My pleasure. Have a wonderful holiday break and a great new year.
Same to you.